Welcome to Inside Asia, a podcast by SEB where we try to connect the dots and make sense of what's going on in Asian economies and financial markets and how that impacts financial investors and companies in Northern Europe with a presence in or an exposure to Asia. My name is Fredrik Hähnel. I am head of Asia for SEB, and I'm also the general manager of SEB's branch here in Singapore, where we are recording this pod on the 12th of September in the afternoon local time. And with me to discuss these important issues, I have no one less than Sean Yokota, head of markets at SEB Singapore. So first of all, welcome, Sean.
Thanks, Fredrik. Nice to be here.
Just to give our listeners a bit of a personal background to who you are and all the different perspectives that you have on the Asian economies, I thought I'd give a very short, very personal intro. Are you ready?
Yeah, go for it.
So you are born in Japan. You're Japanese by origin, of course, speak fluent Japanese, but you moved quite early in your life to the US. You're US educated. You later became a US citizen. You have lived in China for some time. You've spent many years of your career analyzing China, but you have a Korean wife, and the two of you are living with your family in Singapore, where you are working for a North European bank. Is that a good summary of your background, or did I miss anything?
Yeah, that's about right. And the key is that I'm from Japan and my wife is from Korea. And historically, these two countries don't get along well. So we try to keep things as neutral as possible. So, what about you, Frederick? You have a unique background as well.
Well, not as unique as yours, Sean, but yeah, I've lived for over 20 years in Greater China, in Beijing, Shanghai, and the last 7 years in Hong Kong. My wife is Chinese, and we live here in Singapore, kind of similar to you. But I thought we should start by addressing the big elephant in so many rooms around the world at the moment, be it boardrooms or be it executive rooms of companies or rooms where decisions are made among labor unions or around the breakfast tables in working families. And of course, I'm talking about inflation. Now we have rampant inflation in both the US and Europe, and we have almost every single, or maybe every single central bank in the Americas and in Europe hiking rates. I mean, we had the ECB even hiking rates by 75 basis points very recently. But here we are in Asia. We've seen a number of banks hiking rates as well, or central banks hiking rates. But the second and the third biggest economies are in Asia, and they're not hiking rates. On the contrary, they're actually easing. One of them lowered rates twice this year, and the other one has kept promising to do quantitative easing forever and ever after. And of course, I'm talking about China and Japan here. And Sean, as you look into 2023 and beyond, do you think that Asia will be an inflationary force or a deflationary force for the global economy?
In 2023, yes, I think they will be inflationary force. But for this year, China and Japan, they're still having issues. That's why they're not hiking rates. Both of them, their headline inflation for China and Japan is around 2 to 3%, compared to if you look at US and Europe, it's running at 8 to 9%. So they don't really have reasons to be hiking interest rates. But what's happening is pretty much COVID. You hear a lot about China's zero COVID strategy, and that's what's leading to lower growth and then lower inflation. And it's similar thing is happening in Japan where you don't hear it as often, but their COVID strategy is relatively tight as well. They still don't allow foreign tourists come in unless it's in a group organized way. So that's what's leading to economic weakness and not much inflation. But I think Japan already probably by end of this year will start to open up. And then by next year, the economy is going to be picking up and you'll get inflation coming back up. China's probably a bit later, more towards second half of 2023. But I think that'll happen with the opening of COVID. And then you get growth and inflation coming out of China as well.
But does that also mean that you are a bit positive on the outlook for the region, both for China and Japan as they open up? And what is your outlook on a very, very broad level for Asia going forward? Is Asia going to outperform the rest of the world? Should investors or companies increase their presence or increase their exposure to this region, in your view?
Yeah, I think there is this age-old decoupling question where if the US economy slows down, can China or Asia kind of accelerate at the same time? And I think that is always going to be hard. If U.S. or Europe goes into recession, Asia's going to follow because they're export oriented. It's just that they're going to fall less than what U.S. and Europe are going to do. And I think that's kind of the scenario that you're going to get, where as the Fed and ECB tries to slow down its economies, that's going to drag Asia lower with it. It's just that since Asia is going to be coming out of COVID later, I think they're going to outperform what's happening in Europe and US.
Let us turn to talk a little bit more about the Chinese economy, since it is so important for the region as a whole, and of course also for the world economy, being the second biggest economy in the world. I mean, it's also, of course, very important for European companies. Typically, for an industrial company from North Europe, China stands for some 10 to 15% typically of global sales. In some cases, 20 to 25%. And it's also, of course, the biggest export market for almost all countries in Asia. But if you look at the economy short term here, it doesn't look to be in particularly great shape. GDP shrank by 2.6% in the second quarter versus the first quarter. Import volumes are down quite a bit over the past summer and also in August. Logistic numbers are down. Construction of new homes is down by over 40%. Youth unemployment is close to 20%. So short term, it doesn't look particularly good, right?
Yeah, unfortunately, it doesn't look that great. And I think the biggest one is the construction sector, where it's in a recession. And we have a SCB China construction indicator, and this shows a more painful recession than what we saw in the 2008 global financial crisis. But one thing we've been very surprised this time has been how disciplined the government is. So before, anytime there was some kind of slowdown or a recession, the government would be quickly pumping money into the system, giving out more loans, and doing a massive fiscal stimulus. But this time, they're providing only minor support. And you could say that President Xi is doing the right thing by not printing money to fix all problems, which is what the US has been doing for a long time. But yeah, short term, this is painful. It's not very good for growth. But maybe over the long term, this is going to help structurally Chinese economy develop in a better position.
Okay, so you've mentioned the zero COVID policy in China already. You mentioned the construction or the property sector. And I thought we should also talk a little bit about the energy sector with China's energy crisis. So would it be fair, before we start that, to say that the three major headwinds for the Chinese economy are the zero COVID policy, the property sector, and the energy crisis?
Yeah, those are three drivers right now.
So let us, dig a little bit further into these three factors and see how long-term versus short-term they could potentially be for the Chinese economy going forward. If we start with zero COVID, if we rewind a little bit and look back, I mean, COVID broke out in China, in Wuhan. It spread to the rest of the country. In China, very quickly, once they realized that they couldn't control this spread, they locked down the entire country for a couple of months. This became kind of a blueprint for the rest of Asia. Many countries adopted this zero COVID policy for quite a long time after that. And this worked pretty well for China. If you look back, China quickly got it under control. China kept its borders closed, but the economy actually opened up, and consumption came back quite a lot. Investments came back, and you could also see how China very quickly could restore its supply chains. And China was very, very well positioned for this. If you analyze it now and look back, I mean, China already before COVID stood for over a quarter of global manufacturing of goods. And so once other countries started to stimulate their economies quite a lot, and people were stuck at home and they started consuming goods very much. I mean, Chinese exports boomed. At one point, China's exports increased by 35%. And so China was very, very well positioned and kind of a winner economically speaking at the beginning of this. But then later, Omicron came and everything changed in China, right? It was much, much more contagious. China's zero COVID policy didn't work that well. China had to over and over lock down cities, and China keeps testing people all over the country. If you look at it today, for example, I mean, over 30 cities are in partial or full lockdown. Some 80 million people are affected by this. And if you're a consumer in China or a citizen, you have to test yourself in many cities at least every 72 hours, sometimes every 48 hours, and you have to prove that you test negative. Otherwise, your app that you have to use and register wherever you go, to a restaurant or a store or whatever, will be read, and you will not be allowed to enter. Right, and you can also be traced if you've been to a place where someone else was with COVID, and you can receive a message that says you have to test yourself again. If you test positive, you may be required to go into quarantine in one of these isolation facilities outside the city you live in. I'm just giving this background so that our listeners get a feeling for how enormously affected consumers and citizens actually are in China by this zero COVID policy, and how difficult it will be for the economy to turn around before there is an adjustment to this policy. So my first question here, Sean, is when can we expect the zero COVID policy to be adjusted in China?
It'd be great once all this goes away. So then it's really about hope. Um, so in middle of October, there is a party congress meeting, and there is a hope that maybe after that they can ease on these COVID restrictions. Also, President Xi Jinping and Premier Li, they will start to travel internationally for the first time since COVID has started. So that could also signal easing in COVID strategy going forward. But as you mentioned, I think because this is extremely contagious and it's not just the big cities, it's just spreading to other parts of China. I think it's going to be really hard for China to do a big bang opening like other countries have done around the world. So that's why I think China is usually conservative. It will take some time. So I really think it's still a second half, middle 2023 story when they start to ease these zero COVID restrictions.
And do you expect us to be able to read anything from the party congress in terms of signals on where this is heading?
Yeah, I think Party Congress this time, I don't think they'll say much about the zero COVID strategy because Xi Jinping has said that it is a zero COVID strategy. So it'll be hard to go against that. So a lot of it will be just on pure politics on what to expect. And but I think there won't be that much changes because Xi Jinping is at the very top. He's going to stay as a leader. So I don't think the makeup of the party congress or the Politburo or the top members will change so much. So there are some little changes where, of the top 7 members, maybe Xi's supporters will take up 4 out of 7 instead of 3 out of 7. Or in the top 30 members, he'll take up 80% of the supporters versus 70%. So I think you'll see very little kind of policy changes coming out of this.
And just to guide our listeners a little bit, the party congress will take place mid-October to 16th of October, I think it starts, if I remember correctly, right?
Yes, the
And
16th.
it goes on for a week. This is like this takes place every 5 years, and this goes on for roughly a week. And at the end of this week, we will see these announcements of these political, the different members of these political bodies that you are mentioning here, right? After that, hopefully, gradually, a little bit positive news potentially that China starts to adjust its zero COVID
A lot of
policy. Of
hope.
course, a lot of hope, and of course, depending on the development of COVID itself and the rollouts of vaccines and a lot of other things that we could have, of course, talk about as well. But at least it gives us a little bit of hope that this may not be a necessarily long-term drag on the economy. But let's then turn to the second sort of headwind that we started discussing, and that's of course the property downturn. And again, if we look back, this is partly self-inflicted by the Chinese authorities that try to avoid, property bubble building in China by restricting access to credits for the developers, the property developers that are, sort of generally speaking, very indebted. Everyone knows, I think, about, of course, the most famous one, Evergrande, which is the most indebted property developer in the world, actually, that ran into a lot of problems earlier and is now under reconstruction. But there's been a lot of other, of course, also property developers running into trouble. Some 30 defaults have taken place of real estate companies in the offshore bond market. We've seen a lot of boycotts of buyers of property in China that have bought their properties and prepaid for them, and this has become kind of a financing vehicle for these developers. But now that they run into trouble, they can't finish these projects, and a lot of people are now very worried and upset and refuse to pay their mortgages, etc., and have organized themselves online. But this has also led to China taking a lot of action. Recently, you see more sort of stabilization funds being raised, and you also see Chinese banks being guided to support these projects so that these properties can be finished. So maybe we can see a little bit of a light in the tunnel short term. But if we look at the bigger picture here, Sean, and the long term problem, of course, with the real estate sector contributing to, some people say, roughly 30% of the Chinese GDP, it accounts for some 70% of household wealth. A lot of Chinese people don't invest in stocks and bonds, etc. So they buy a second flat or a third flat, etc., as a storage of their wealth. You see, some people even say that it's the biggest asset class in the world, Chinese property. I don't know if that's true or not. You see, Chinese local governments, a lot of their funding comes from selling land for property projects, so they're also very dependent. You see a large part of bank loans being to these projects, so they're also very much exposed. And now when you have some, home prices down for some 11 months straight in China, you have, some people say, roughly 50 million flats standing empty in China. Some people say it's even more than that around the country. And you have a population that will start to shrink. Either it started already now, some people say, others say it will start in 2025. You have no immigration in China. You see where this is leading. This question is leading. I mean, with the property sector being such an important driver of economic growth, is there an end in sight, and how worried should we be?
China's property is a major concern and a risk for China itself. And the main issue is that the land and property prices in China are just too high, especially for where China is in its economic development of making its 12,000 US dollars when you think of GDP per capita. And this is actually leading to multiple things, some things you've mentioned also. So the demographics issue can be tied to property prices because land apartments are too expensive, so you can't have really big families. Um, and then it could be also tied to like food security, where because land is expensive, it's hard for people to farm and they can't grow enough food in the country. And there's only two ways to really fix this. One is to grow the economy by other means than real estate. And so real estate and everything related to it is about 30% of GDP. So China needs something to replace that. And usually, China property is fueled by debt. And debt means you're just bringing consumption forward. So you borrow now, spend, and then pay back over time. So you're just bringing growth forward. So in this way, this is something you can't replace. It just means that China's economy is going to slow down if you want to rely less on property. And then the second issue is something you also mentioned. It's about the local governments, in that for them, they have no way to collect revenue so much, but they have all these expenses that they have to pay for social services. And since they can't collect money, they sell land and then they start construction projects. That's how they create income so that they can pay for social services. And so this formula has to switch where the central government either has to give the local governments more money so that they don't have to sell land to pay for these social services, or the central government has to pay for all these social services for the local governments. And it doesn't seem like they want to fix this. So until they tackle these issues, I think it's not going to be resolved. And the price is that you just live with less growth.
And just quickly, what do you think will be the main drivers of China's growth going forward? Will it be consumption, other kinds of consumption? Is it going to be investments into renewable energy? I read, for example, that China invested more in wind power in 2020 than the rest of the world combined. Is this going to be the driver, or what do you think?
I think generally you're just going to live with less growth in China, as this is hard to replace. And when it comes to renewable energy projects. I'm not 100% sure on how committed they are. Usually, I think China is committed to something once you see it in the 5 year plan that they publish. And the last 5 year plan was published last year. And they usually give specific number targets if they want to invest. And there weren't any number targets on them. So I think it's hard to rely on that one. And so I think the main engine that China has to rely on is on consumption. And you try to gain consumption by maybe trying to reduce savings. Savings rates in China is pretty high because people don't know, they don't have a pension system, they don't know how medical prices will move up and down. And because the economy is not so stable, people tend to save more because as an insurance. So if China can produce very good social systems that makes people comfortable, then maybe they can save less and consume more and act that as an engine of growth.
Good. And you mentioned, you replied a little bit to this question on renewable energy. And that, of course, leads us to the third headwind, which is the energy crisis. We talked about at the beginning as well. You know, Europe has its energy crisis, but China actually has its own, right? We saw last winter factories, uh, out of which many were foreign companies in China, that had to close their factories with very short notice because there wasn't enough power in the grid. We've seen that improved last year, but we've seen that this summer again, right, with a heat wave in China, with the droughts in the rivers of China, etc. So, now, what is behind China's energy crisis in general, in your view?
Yeah, so far we're talking about all the problems that are related to China. So it sounds a bit pessimistic, but yes, we'll tackle this one as well. Um, yeah, it is related to something that's happening in the rest of the world with the droughts and the climate change and hot summer. And that's leading to demand for air conditioning going up, or there's not enough water, and 17% of China's electricity is hydro related. You heard of the Three Gorges Dam, which is the biggest power plant in the world, and it's run on hydro off the Yangtze River. And with less water and rainfall, they're having problems generating electricity. You're also seeing some, again, food getting impacted because of the less water. Um, so sadly, these are things that are hard to fix short term. And if anything, climate change is taking an impact on this, where if you don't have enough hydro, China goes back to mining coal and restarting coal plants at the expense of the environment.
But we also see China spending more on energy imports, right? We see that in many countries around the world, but also in China. I read that Russia has now surpassed Indonesia as China's most important import market for coal. China imports quite a lot of oil. That's also increased quite a lot this year. I think it's the second most important import market for China after Saudi Arabia. China also imports more gas from Russia this year, and of course, this leads us to the whole discussion on geopolitics, and this is of course quite sensitive in these days with. Europe trying to sort of get rid of its dependence on Russia for imports of gas and oil, for example. So tell us a little bit what's driving this and what implications does this have for the geopolitical situation?
Yes, on surface, it looks like China's relying more on Russia, and China's taking Russia's side in this Ukraine war, and that's why they're getting more energy from Russia. But China, I think, is always strategic and thinking long term, and they don't want to rely on any country. And I don't think they trust Russia 100%. So they don't want to be fully reliant on Russia. So if you look at kind of like their energy mix, of course they have a lot of oil, but as they move with ESG, then they'll try to get them onto electric vehicles. So it really comes down to where do they source energy to for the electricity power. And like everybody else, they're trying to move to natural gas because it's cleaner. And then they want to use LNG instead of piped gas because of what we see in Europe, that piped gas can run into problems. And so the key is to look at China's LNG and where they source it. And I, I thought it was funny that 40% of their LNG imports comes from Australia, which is number one, and number two is from the US, which is 11%. So that means half of their LNG source is from kind of their adversaries or enemies. So that means it's kind of optimistic where I don't think they want to start a war with the US right now because then they wouldn't have any energy. So I think this is kind of one optimistic thing that you see that maybe it looks like on surface they're on Russia's side, but they're really reliant on the US.
Very interesting. Let us stay on this subject and with geopolitics, Sean. And again, I ask all the difficult questions here, so I don't want to bring this discussion to we'll bring up some positive aspects in a little while. But of course, one big thing we can't avoid talking about is the tensions around Taiwan. We had Pelosi visiting Taiwan recently, and that led to, of course, the biggest military exercises we've seen to date. A lot of red lines were crossed, not least the line in the Taiwan Strait, where more ships and airplanes than ever crossed this line. So we feel a little bit that the whole status quo has changed. We saw China sending even missiles that flew over Taiwan and landed in the waters of Japan. The U.S. later approved 1.1 billion US dollars in arms sales to Taiwan. So I mean, this looks pretty dramatic, and we also see that this has continued after these big exercises with more politicians visiting Taiwan from the U.S. We've seen French politicians visiting. We've seen Japanese politicians visiting, and China has continued with these exercises. I mean, I've been out here in the region for many years, and you've been been active also in this region for many years in your career. And it's always been an issue with Taiwan, where everyone has always said that this is something that could, be a source of worry at some point in the future. Do you think that this worry has gotten closer to us now? Should we be more worried than before? And how should investors, financial investors, or companies look at this as we continue to do business in the region?
Probably in addition to climate change, long term US China tensions are probably one of the bigger risks that you're going to see, especially in this part of the world. And the Taiwan issue has recently escalated quite a bit. I think amongst my friends, we say that China Taiwan conflict it was on a 20-year time horizon, but after what's happening now, maybe it kind of shrunk to a 10-year time horizon. And I think it comes from US view on how they saw Hong Kong and how fast Hong Kong kind of merged with the mainland over the last couple of years. Everybody knew that was going to happen, but not this quickly. And I think that really woke everybody up to say how fast can China merge with its other neighbors, such as Taiwan. So this is a kind of a major risk that we see long term that investors have to deal with. I guess the good news is that, especially in the next 2-3 years, I think it's something you don't really have to worry about, and that's just due to COVID. That China still has major issues to deal with domestically, with the zero COVID strategy and how low growth is and how high youth unemployment is. So I think they have to tackle some of these short-term issues first before they worry about Taiwan. But yes, I think over like a 10-year time horizon, this is a major issue that we all need to worry about.
And if we take more of an overall Asian perspective on this, do you think that Asian economies in general risk being stuck in the middle here in this conflict between the US and China? And is it a conflict between sort of military security on the one hand, being the US offering sort of a counterweight to China's increasing influence in the region? So sort of a military security uh, sort of support on the one hand, and an economic reality on the other hand, considering that for almost all of these countries, China is by far their biggest market. I mean, I went through some export numbers before this podcast, just looked at Australia, India, Indonesia, Singapore. Even I looked at Taiwan. Taiwanese exports to China is 42% versus only 15% to the US. It's not that extreme for the other countries, but for all countries, basically, China is their biggest export market, and the US market in sort of a comparison is considerably smaller. So I come back to the question: Is this are they risking being stuck here between the military security assurances on the one hand and economic realities on the other hand.
Yes, I agree. I think that's the best way to frame it is that you have one end where you focus purely on economic growth. And if countries bother you, you just say, I'm sorry because I care about the economy, and you let them go. And then on the other side, you have, I care purely about security. I don't care the cost to the economy. I just care about being able to exist the next day. Maybe Russia's kind of on this side right now, where they don't care that much about how the economy's getting hit. And I think that's kind of the two extremes that you have in geopolitics. And I think ever since Xi Jinping came into power, I think he has moved China from more towards economic growth to security. And you see that by how they're setting up aircraft carriers in the middle of the ocean in the South China Sea, or by soft power by influencing by the Belt and Road Initiative, by building infrastructure and trying to win some political gains outside of China. So they've kind of surely moved to the security side. And it's the same on the US side with these tariffs put in place that it's going to cost economically implementing these tariffs, but for the sake of security, we're going to do this. And so everybody seems like they're moving to the security side at the expense of the economy. And for countries in Asia, which are really reliant on exports and imports and trade, security and all these things blocks this, and it becomes very painful. So I think it becomes tougher generally for the region.
And you also see, at the same time, you see both the US and China really trying to engage more and more economically with the other countries. We had China at the beginning of this year launching the RCEP, the biggest trade pact, I think, ever being launched in terms of number of people living in these countries or the size of their economies. But it's been criticized for being largely symbolic so far. But at least they did that. And then the US has also launched their initiative, their Indo-Pacific Economic Framework, which is also a way of trying to re-engage more with the region economically. But do you think that it's too late for the US to sort of hold China back?
I think it is too late for US to think about containing China. I think it's too late for US to try to contain India as well. So I think those options are very tough. And the funny thing is that I think US and China, the superpowers, they think in terms of containing others. Whereas these countries in the middle that are stuck, like Korea or Japan or Australia, they have moved on to this word of coexistence because they need China for economy, or generally they're just neighbors. And so what they want to do is kind of set some rules in the ground to say, okay, this is where we stand. Maybe we'll get punished for this, but we need to kind of keep it going so that we can have a dialogue, we can have a process for reconciling differences. Until we can set up this process, we're never going to resolve anything. So in some ways, Japan has set this thing called a Quad with the U.S., Australia, um, and India together to counterforce China. But this is kind of a system to say, okay, this is where we stand, and if China doesn't like it, let's try to reach some kind of consensus, and then try to move forward. And so I think the Asian countries are the ones that are moving forward to reconcile the differences between US and China. And this is really important for these Asian countries because when the two superpowers usually fight, both of them, they have some losses, but they do okay. But the countries in the middle, they get obliterated. So it's very important that these two superpowers get along because the ones in the middle are the ones going to pay the price.
Sean, many people talk about Western companies now applying a kind of a China plus one or China plus two strategy, keeping investing in China for the important Chinese market, but complementing further investments in Southeast Asia to diversify and risk mitigate. Do you see such examples?
The part with China that's difficult is that it's a very big country with so many people that it's hard to replace China with one strategy. Like I said before, GDP per capita is 12,000 US dollars, but because it's such a big country, you can get skilled people you can hire for 40,000, or you can get very low skilled for 3,000. So you can get everything in one place, and the scale and the supply chain, that's what was very attractive to China. So it's really hard to replace. So I think what companies need to do is they need to now start to chop up their process and production facilities. So if they really want low end, they have to go to some place like Myanmar or Bangladesh or even India, where GDP per capita is about $2,000. And then if you want to move up a little bit higher in that rank, then you go to 4,000 US dollars, which is like the Philippines, Indonesia of the world. And then if you really want high end, I think companies move things back to Eastern Europe to the places like Poland, where it's like 18,000 US dollars in GDP per capita. So unfortunately, it's a bit more work that companies have to do, and that they have to split it and kind of rearrange it around a bunch of different countries when they want to replace China's strategy.
And what's your view of Indonesia and India in that perspective? Because they're also, I mean, in India, you kind of see a combination of those two: low-end manufacturing, very cheap such, but also a very, very big and potential market.
Yeah, I think the two countries I think that are the biggest winners out of all this is India and Indonesia. Probably India is the first because geopolitically they are kind of in the sweet spot where China's trying to court them because China doesn't want a big neighbor like India to be on the opposite end or an enemy. So China's trying to get them on their side, and US is trying to get them on their side as well to kind of off balance China's power. And India has a positive with the ESG theme as well, because they're big enough, and then they have to move to renewables, so they have scale and there's a lot of investment potential as well. And India, despite its problems with land and red tape and not enough electricity supply, the economy continues to grow. So right now, their economy is $3 trillion, which is same as where China was in 2007, just 15 years ago. So it does continually grow and has big potential. Indonesia is something similar. It's almost the same size population to the US, so it has a very big domestic demand. And similar to India, everybody's trying to court them to be on their side. And another positive with Indonesia is that they have a very good commodity supply themselves, or they have energy security. So they don't have to compete with Europe and India and China to get LNG from the rest of the world. So yes, despite all this, the two kind of winners in this geopolitics is India and Indonesia.
Sean, I could go on forever and ask you more questions. This is such an interesting subject, but I think it's time for us. We have to wrap up. Just before that, just a very, very quick question on financial markets and particularly on currencies. There are so many currencies we could discuss here, of course, but just on China, where we started, China and Japan, because we've seen this very, very significant drop in value of the yen this year, roughly 40%, which is very uncommon for such a big currency, of course. And we also see the renminbi approaching 7 here. And considering what you said at the beginning, these countries will start to open up and you will see maybe inflation coming as well. What is your view of these two currencies as we approach 2023?
Yeah, so the renminbi, I think it's going to continue to depreciate. So 7 is an easy target. I think 7.2 is the other target to hit. But beyond that, I think it's tough where as a Chinese official, you don't want your currency weakening so much in 1 year, because then that'll lead to domestics taking money out, which happens very quickly and it's hard to control. And you have capital flight, and that leads to so many different problems. So I think China will try to control this and limit the pace of depreciation. It's just that when this happens and they start to intervene, it could cause other problems that people should be aware of. And that is that they have to sell down their reserves, which means they have to start selling US treasuries. So, in an environment where US yields are going up, you might have added pressure from China selling US treasuries. So, there is a currency impact of a weaker RMB, but it could also lead to higher yields in the US.
And quickly, how about the yen?
It seems like there's nothing stopping it. Um, it seems like US Treasury and Ministry of Finance in Japan kind of reached a deal where it's okay for dollar to strengthen and yen to weaken. So there's a bit of like an anti-plaza accord, some agreement that they had a long time ago to strengthen, the weaken the dollar, but the other way to strengthen the dollar this time. So you could see it continue to weaken beyond this. So as the yen weakens, yeah, it just puts more pressure on the renminbi to weaken. I think that's another thing China needs to tackle, which I'm not really sure how they're going to do it.
Thank you. That brings us to the end of this podcast. Thanks a lot, Sean. Great talk.
Yeah, it was a great conversation. Thanks, Fredrik.
And we will be back soon with another episode of Inside Asia. Thank you so much, everybody, for listening.